Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acrivo. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together.
Welcome back to PlotLines, everyone, where we uncover the truth behind the headlines in the real estate sector. With us today is Marcus Arredondo, principal at Edge West Capital, corporate managing director at Savills, and host of the Scales of Success podcast. Welcome, Marcus.
Thanks for having me on.
Thanks for joining us. Tell us a little bit about yourself, your background. You're obviously an accomplished real estate connoisseur. So tell us a little bit about your background, your journey, and how you got here.
Well, I've been in real estate now for about 2 decades, the majority of which has been in a corporate real estate advisory capacity. So we represent tenants, larger corporations in their occupancy. So that ranges from sale leasebacks to their leases to build-to-suits and the like. For the last 7 or 8 years or so, I have been investing, starting with single-family, small duplex type investments, and have broadened into larger multifamily investments, which has hit, their own challenges over the last few years. Yep. And over the last year, I started a podcast called Scales of Success, where I have discussions with entrepreneurs, CEOs, leaders, and creators about their points of inflection in their achievements through the lens of resilience.
Okay. Interesting. Awesome. Yeah.
Well, kudos to you. We know how difficult but rewarding it is to have a podcast. So we'll definitely check it out. Okay. So as you know, the premise of the podcast is all about breaking down headlines. We want to tackle both office and multifamily with you today. So maybe let's start with office, and we can kind of do this in 2 parts. But the headlines for office are actually probably looking the most positive we've seen here in a while. But it seems like there's this theme of tenants still competing for prime spaces, not being able to get the space they want, et cetera. So tell us what you're seeing on the office side. We know you represent tenants. Tell us a little bit about, is that accurate? What are you seeing on the ground?
Well, if we could just hit pause, go back a little bit in history, but clearly the history deviated at the point of COVID.
Sure. Right.
And it wasn't just the fact that people stopped going into the office during that time frame. Zoom had a breakout. Supply chains were impacted. Down that line, as inflation grew, we started to see cost bumps on a number of different fronts, not the least of which being the cost of payroll, the cost of material, cost of labor, cost of insurance. So these are all sort of headline things that wouldn't be necessarily surprising to anybody. To go back to your specific question, real time, there is absolutely a flight to quality. Those who have strong balance sheets, those who are forward thinking, those who are willing to make defensive plays are looking at the future as something that they can capture now. I will say, though, that we are seeing, I'm not sure if it's positive as much as it is less negative than it used to be. And I think there's a distinction there, only that, we are still significantly behind where we were pre-pandemic levels. And if you look at availability versus sublease space, a lot of sublease space is burning off. So headline might be saying that subleases are fewer and far between. But that is in part because they're switching to direct space that's available.
Right.
And so the rubber is going to meet the road on a number of these CBDs, not the least of which being Los Angeles, where I'm at. I wouldn't be surprised seeing almost all of the buildings in downtown LA over the next 24 months have some capital event, whether that's an outright sale, an outright foreclosure, or something in between with recapitalization. But occupancy is something that is struggling to recover. There are stronger mandates, especially now that the new administration is in. I'm very curious to see how this plays out and the ripple effects from that. But from an office occupancy perspective, if I were a landlord, I would see these as positive trends because starting with the federal government, you've seen a number of other companies preceding that and following it. Add to the longer list of employees being mandated to come back to office. But I think as much as it pains me somewhat, I think the cat is out of the bag. I don't foresee occupancy being mandated on 100% of days like it once was.
Right.
There is just too much efficiency that is gained by having some hybridization. But I do think for the foreseeable future, hybridization is going to be a very strong pathway forward.
Right.
Okay. All right. So more to talk about there, but let's
sure.
shift gears quickly over to multifamily, and then we can get into all of these trends further. But on multifamily side, the headlines really seem to be pointing to oversupply, rent growth declining. Let's get your thoughts on multifamily, and then again, we'll get into all these layers of both.
Well, I won't obfuscate that question by saying that it depends on location, but it really does depend on location. Generally speaking, I think the data suggests exactly what you're saying, that we did see rent declines. We saw rent decline in some of the key markets, primary markets that were very attractive for a number of investors and a number of residents. Now, not surprisingly, those areas did have an abundance of development. The development is not surprising either. When money was effectively free, those population trends started to shift. So geographies started to balloon in ways that they hadn't preceding that. There were opening avenues for people to work from home. But that supply is coming and has come to fruition, and it has put downward pressure on some of those markets. But what you're starting to see in the last quarter specifically, we'll see what the future holds. But we've seen, those occupants who can no longer afford those new Class A plus rents coming into the A minus and B plus category. So those occupancies have strengthened. Once occupancy strengthens, it's not surprising that rents start to rebound. The bottom line data, and I'll land the plane here. The bottom line data is that there are still population trends, employment trends in a number of these key markets. And despite the fact that the supply has increased, that absorption is taking place, and it is not in perpetuity where that's going to be extended. The existing development starts have effectively stopped. You are not seeing any development occur right now. And to be completely blunt, I mean, a lot of existing trades are being sold because they're so far below replacement costs. Replacement cost now is significant. And when you're looking at rates where they are, and you're seeing that rents are not increasing at the rates that they once were, they're not penciling like they did in 2020,
not
2019, 2020.
Compelling of an investment, right? Okay. These are definitely interesting sectors right now, both of which are being shaped by changes in, consumer behavior, right? Which we talked, you already addressed a little bit in terms of that, partially that work from home model and how that impacts office and multifamily demand on both sides. What are, in your view, what are you seeing that landlords are doing to make both office spaces and apartment buildings more appealing to their occupants?
Absolutely. So I think there's a through line, which is amenity space, and it can be fundamentally described in any number of ways. But from the office front, what is the number one landlord objective, which is to serve employers and serve their best interests. Employers' best interests are to maintain employees happy, to increase their recruitment, to increase their retention. And how do you do that? By having more amenities within the space and throughout the building. So with respect to office, you're seeing a big push for communal workspaces. So for example, we've seen a big push for existing companies who have a need for conference rooms and meeting rooms to no longer take that onto their ledger and instead use it on an ad hoc basis in the community spaces that the landlord is offering. Those community spaces are oftentimes being tenanted by other management companies. So that'll include it's partial co-working spaces as well. So, there's a coffee spot, there's probably a sandwich spot, there might be a gym component. All of those things allow for even potentially some daycare or, some childcare assistance. And so it really just enables more flexibility when you're at work to either get there sooner, get there earlier, stay later, and to be happier while you're there to incentivize you from leaving and instead stay there and have collaborative, non-strategic conversations with other people in your office, but also to get back to work quickly. On the multifamily side, I've seen something very similar. So gyms are a big push. I think when you climb the ladder in quality asset, you're definitely seeing a bigger push for co-working space. Sure. But even, gyms and having activities within the community so that people don't need to leave. But there is definitely a quest for value. People want value. And so to the extent that they can both live in a location and not have to pay for some co-working space or not have to pay for a gym, it substantiates increased rental rates because they don't, their problems are solved in one location.
Sure.
All in one. Yeah.
Yeah. Okay. So amenities, we obviously hear a lot about that being sort of a driving demand for space. But what other leasing trends are you seeing in both office and multifamily?
Well, in the office space, like I said, I think those who are well capitalized, those have strong balance sheets, those who are wanting to take forward momentum, they're able to price their future at a much lower rate. And while we haven't seen face rates plummet like some might expect based on occupancy trends, we are seeing deals inked where they're buying down the rate in concessions. And when you can take a long-term defensive view, and what I mean by that is instead of taking a 3-year term, you can do a 5, 7, or 10-year term, and you can include in those options to either contract or expand based upon your needs. It really gives you the pricing you need with the protection you may want over the course of the future. Those it's not dissimilar to just the general office market, but employers tend to use debt as well. And debt, the cost of capital is more than it's ever been in recent history. And so those who are on the fence, those who are not plush with cash, they are less likely to be taking those bets. And so they have to be a bit more strategic and probably take shorter time frames. But I will say, and this is a theme that I'll say sort of throughout, if you are an occupier, be patient, be strategic, be assertive. There are terrific opportunities right now, especially for landlords. But as you're doing that, the last point I'll sort of highlight on the office landlord side is make sure that the landlords are capitalized. Because if you ink a deal with a strong tenant improvement allowance and that landlord ends up going kaput, now you're in a situation where you're going to have to institute self-help. And are you in a place where you can financially make that commitment?
Stomach that,
So to transition on the multifamily side quickly, I think it's a little bit simpler. I think it's relative to the demographic you're serving. I think you need to serve that those desires. So if you're looking at A minus, B plus, I think those amenities like co-working space, a coffee shop, something to the effect that would make it a more pleasant experience, almost hoteling to some degree, where you almost feel a hospitality element there, I think is a stronger draw. If you go down into workforce housing where you're in, 1980s build, 1970s build, I think those are more functional for families. I think you start to see pools and gyms is a big factor, but also what's included. Is the internet included? Do you have cable access? Are you having to pay out of pocket for your water and sewer? Or is that included?
Sure,
So there are nuances there that I would highlight for both the owner and the resident to identify what makes sense for that market.
Okay, interesting. All right, one of my favorite topics that is actually the crosshairs of both of the worlds that you're talking about or that you're focused on is let's talk about the viability of office building conversion into multifamily. We've had a few guests over the year that we've been doing this that are dabbling in it. We haven't seen a ton of execution there. What are your thoughts on it? Is it practical? What makes it practical? And will we see more of it?
Principally, I think it's a brilliant answer. When you look at it pragmatically, things start to look a little bit different. And I'll start with the end, which is that I have a lot of challenge seeing how this pencils without some government incentive,
Yeah.
whether that's through tax abatement,
Yeah.
through some other means. But there needs to be some community support in order to make that feasible, because like I said before, the cost of capital is high. And in many ways, going into a building to remediate for something so substantially different
Yeah.
than what it was originally purposed for can actually be more cost intensive than if you were just to have a blank
Ground up.
slate.
Yeah.
So I'll just give like minor examples, but if you're talking about elevator wells and the bay depths of an office building, for example, where there's typically, let's just imagine an oval shaped office floor plate
Yeah,
with
yeah.
an elevator in the middle, with some bathrooms in the middle, you're talking about completely rejiggering the riser space, the electrical, the mechanical, so that each individual bay, which would not typically function as a residence because you only have so much daylight that can come in, you're not typically going to have a balcony on the 70th floor of a 100-floor
Right.
high rise. So I think there's a lot of complications there that really need to get unearthed, and I think it's going to take some creative people that make it happen. But more specifically, I think it's going to be people with buying power.
Yeah.
Yeah, sure.
Makes sense.
Let's dig in a little bit, Marcus, to the financing environment for both sectors. Tell us a little bit about what that looks like right now.
So if we can just take a pause on that, and I'll do this again, but let's rewind to 2008. And
Yeah.
we saw what sort of catastrophe that was. And we can comment and Monday morning quarterback Jerome Powell and his team and what they're doing. But ultimately where we are is, instead of having that immediate recapitulation between ownership and buyers, a lot of those cans have been kicked down the road. So there was a wall within multifamily, it was referred to, where loans that were taken out in 2021, 2022
Yeah.
were all coming up with it, because they're typically 2-3 year horizons.
Yeah.
Many of those lenders, rightfully so, have kicked the can and said, hey, look, let's give you a lifeline. Let's extend that out.
Yep.
That's not entirely dissimilar in the office world. But
right.
there's one fundamental difference in relation to each of these asset classes, which is that multifamily has maintained occupancy and operating income in a way that office buildings are seeing a steady decline.
Sure.
And I'm not suggesting that they won't recover, but at this moment where employers are trying to identify what their long-term future looks like, they're taking it slow, and it's probably not in line with how office landlords would prefer. And so there's a reckoning coming, and all those loans that were kicked the can down the road.
Yeah.
Those groups are going to have to, they're going to have to come to a decision. And a lot of lenders don't want to be operators. So in the office
Right.
market, that ends up going to a special servicer.
Yep.
Oftentimes, maintenance and occupancy is impaired because of that. So they tend to avoid it. The alternative is to take a write down and just sell it outright, and a deed in lieu of foreclosure. A lot of lenders have been reluctant to do that.
Yeah.
But like I said, for downtown LA, for example, I do think that in the next 24 months, those lenders are going to come to the road and make a decision. And once we start to see that happen, I think we start to see office leasing take a different trajectory, because there's going to be a more certain path, and the price to make a deal is going to be different, and the market will dictate it. When buyers come in and say, we can make a deal at this point because we know we can get these lease rates, now things start to make a little bit more sense. On the multifamily side, I think what was coming in 23 and 24 has been kicked down the line, and so we're going to start to see some of that happen as well. But what's interesting is that rental rate decline is slowing. We're starting to see rental rates start to pick up in the last month or two.
Yeah.
And if that persists, coupled with the Fed either holding steady or potentially reducing rates, which I don't put a lot of optimism on at this point, at least people can price it. And the owners who are facing the reality of not being able to meet their debt service are going to be faced with a more realistic solution. They've been holding on to it for 6 months, a year, 2 years.
Right.
And, at some point you got to stop putting good money after bad.
Yep.
call a spade, but I know there's a future present value of pain, and it is far greater than the net present value. And I think we're going to start seeing more of that. And as a result, I think the purchase prices are going to come down. I'm not going to say that they're going to drop astronomically, but they're going to have to start to make some sense from what the cost of capital is and the needs of the lender, which will put pressure on the owners.
All right. So given all of that, and from an investor perspective, sounds like there's a lot of maybe opportunistic opportunities down the line, and maybe in both asset classes. How would you advise investors to navigate the landscape in both of these sectors?
Well, I'll say occupiers should be opportunistic, and investors should be implacable. And there's a theme there, which is patience and diligence. So on the office side, there are deals there. I think the first step is to really identify where your company is, where it's going, what considerations you need to take into effect when is your recruiting pool changing at all? What is the makeup of your existing employee pool? We see a lot of times when law firms, for example, are making a 10-year commitment, they make it based on the managing partners who are in their 50s and 60s. But when in reality, the junior partners are going to be the ones living in that space for a longer term. So it's really about taking a forward-thinking approach in how you're going to resolve some of these challenges. And as far as investors on the multifamily sector, multifamily fundamentals remain as strong as they ever were. No one had ever seen 11 rate increases consecutively in a row, and that aggressively, might I add. So we went from 0 to 550 basis points in 11 different periods, and that put immense pressure when you underscore it by material and labor costs spawned by supply chain challenges. And if you look at history, there's somewhat of a linear approach to how things took place. 2020 was an anomaly. It completely shattered any preceding historical trends. And so how we bounce back from that, how people start to approach the future with that in mind, knowing that it's even a possibility. The last time something like that had happened was 100 years prior. So I do think that the fundamentals are there for investors to continue to having a strong, highly protected return. I think there are some lessons learned from the past, and a lot of it has to do with debt. A lot of it has to assume that, for example, insurance costs going up. I mean, on a broader spectrum, I think the average was 35% increase on insurance line item. And that line item, in some cases, is the second or third largest line item on your budget. And in some cases, in Florida, Texas, Georgia, Louisiana, for example, those were not 30%. Those were 2x, 3x in some cases. So that really hinders your ability. Your NOI underwriting could be above your pro forma, and still you might be underperforming relative to where you are in the market. So there are opportunities out there. I think there are going to continue to be opportunities, but the fundamentals within multifamily remain as strong as they've ever been.
Okay. All right, Marcus, you've given us a lot to think about here. We want to give you the opportunity now to rewrite the headline, and you can write one for office and one for multifamily, or one that you think sort of speaks to both. But what would that look like if you had the ability to write your own?
I think it would be patience, persistence. Both of those are going to be really fundamental. And that's not anybody who's in real estate, who's probably the majority of the listeners, that's not going to be super insightful. But I think it applies now more than ever. When people zig, the common theme would be to zag. We are seeing a lot of dry powder on the sidelines that are eager to come into multifamily, also to potentially come into office for the first time, and to see how these things play out relative, for example, on the office front and the conversion. That's going to be something where some creative thinking could really lead the way. And if somebody finds a pathway forward, I would anticipate that being localized rather than generally across the nation. But if you can find some pattern interrupts that can be repeated, that could be a very profitable endeavor. But as far as occupiers are concerned, I think any strong methodology that involves strategic thinking in terms of what your future looks like. There
Yeah.
are an abundance of solutions at price points you're likely not to come across again for some time. We are certainly at a corrective phase within the market. And for investors, like I said before, the fundamentals, don't be distracted by the noise. The signal here is that the fundamentals remain strong. Occupancy is further being buttressed by the fact that many people are being priced out of single family purchases. We're seeing younger generations who have lower and lower ownership percentages than before. And as a result, I think, just as a quick comment, I think some of those younger generations are looking to backfill that ownership experience with experiential experience. So they want better amenities. They want to travel. They want to have better opportunities that, they can take to the grave, so to speak. Whether that's right or wrong, I'm not here to judge, but I do think that there's something to be said about it. And I think that's the trend we're witnessing. And until the great generational shift of wealth, which should be taking place in the next 10 to 15 years, that's going to be another shakeup that I think is going to be interesting to witness.
Yeah. Great point.
All right. Well, a lot of great insights. Marcus, we really appreciate your time today. Thanks for joining us.
Thanks so much for having me.
Yeah. Thank you.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts